$74 billion. Let me put that number in perspective. As I speak these words, $74 billion is more than the entire GDP of Costa Rica. More than the GDP of over 100 countries on this planet. Enough money to buy every home in a city the size of Dallas, Texas, with billions left over. And in the span of about 4 years, between 1997 and 2001, that amount of wealth, $74 billion, vanished from the pockets of Enron shareholders. Not through a war, not through a natural disaster, not through a recession that took down the whole economy. It vanished because of lies. Because of accounting tricks so brazen that when they were finally exposed, the entire world of corporate finance had to be rebuilt from the ground up. This is the story of Enron. Not just the collapse, but the machine that made it possible, the characters who built it, the culture that fueled it, and the 7,000 pages of legislation, the Sarbanes-Oxley Act, that Congress wrote specifically to make sure it could never happen again. That act was supposed to fix everything. And yet, 20 years later, corporate fraud is still everywhere, which means either the law didn't work, or we didn't learn the right lessons. Enron's headquarters stood at 1400 Smith Street in Houston, Texas. A 50-story tower of reflective glass that the company had emblazoned with its name. A giant, tilted E, made of metal and light. In the late 1990s, that building was the epicenter of what everyone called the new economy. Every morning, thousands of young traders in shirt sleeves walked through its revolving doors, ready to place bets on anything: electricity, natural gas, bandwidth, weather derivatives. If you could put a price on it, Enron would trade it. If you could dream up a financial instrument, Enron would structure it. If you could find a regulatory gap, Enron would drive a truck through it. And for a while it worked. Revenue went from $13 billion in 1996 to over $100 billion in 2000. The stock price hit $90. Wall Street analysts called Enron the most innovative company in America. Fortune magazine gave it that exact title for 6 consecutive years. Young MBAs fought for jobs there the way they fought for Goldman Sachs. The Enron campus in Houston had its own fitness center, its own concierge service, its own daycare. It felt like Google before Google existed, but underneath that gleaming surface, there was nothing. Not vaporware. Worse, there was active deception. There were off-balance sheet entities with names like Jedi, Chuco, LJM, and Raptor. There was a CFO who personally made $30 million from the very partnerships that were hiding the company's debt. There was an accounting practice called mark-to-market that let Enron book profits on contracts that wouldn't pay out for 20 years. And at the center of it all were 3 men, Kenneth Lay, Jeffrey Skilling, and Andrew Fastow, who built a system that was designed from the ground up to look like something it was not. Think about that for a moment. $74 billion is so much money that if you laid it out in $100 bills end to end, it would stretch from Houston to Tokyo and back again. It's enough to fund NASA's annual budget for 3 years. It's more than the combined endowments of Harvard, Yale, and Stanford universities. And all of it was vaporized by a company whose core business, moving natural gas through pipelines, was one of the oldest and most boring industries in America. The tragedy of Enron is not that it was a complicated fraud. The tragedy is that it was a fraud dressed up as innovation, perpetrated by people who convinced themselves, and everyone else, that they were changing the world. This is their story. And the question at the heart of it is not just, how did they get away with it? The question is, why do we keep letting it happen? We're going to walk through this step by step. From the merger that created Enron in 1985, through the deregulation that gave it wings, through the rise of the trading culture, the invention of the off-balance sheet entities, the California energy crisis that Enron exploited for profit, the whistleblower who tried to stop it, the collapse that vaporized 20,000 people's retirement savings, the trials that sent executives to prison, and the law Sarbanes-Oxley that Congress wrote to prevent the next Enron. And then we're going to ask the hardest question of all: did any of it actually work? Enron didn't start as a trading company. It started as a pipeline company. In May 1985, 2 natural gas pipeline companies, Houston Natural Gas and InterNorth, based in Omaha, Nebraska, merged in a deal valued at $2.3 billion. That was 40% above market price, an aggressive premium that signaled just how badly these companies wanted to combine forces. The resulting entity controlled approximately 37,000 miles of natural gas pipelines, making it the second largest gas pipeline network in the United States. It was worth $63 billion in assets, and it was called Enron, a name chosen from a list of possibilities presented by a New York branding consultant. The name meant nothing. It was designed to sound modern, energetic, neutral. The man chosen to run this new company was named Kenneth Lay. Lay was born in 1942 in Tyrone, Missouri, a town so small it didn't have a stoplight. He grew up poor. His father was a farmer who also ran a small appliance store, but Ken Lay was brilliant, and he knew it. He earned a Ph.D. in economics from the University of Houston. He worked at the Federal Energy Regulatory Commission during the Nixon and Ford administrations. He understood energy policy at a level that few people in the private sector could match. And by the early 1980s, he had become the CEO of Houston Natural Gas, running it with a mix of political connections and financial aggression that would define his entire career. Kenneth Lay was a paradox. By all accounts, he was personally kind, soft-spoken, generous, deeply religious. He donated millions to Houston charities. He served on the boards of hospitals and universities. He believed, genuinely, that Enron was making the world better by making energy markets more efficient. And yet, Lay was also a man who never met a conflict of interest he couldn't rationalize. When his own son made questionable trades using Enron insider knowledge, Lay paid a fine and moved on. When Enron's board waived the ethics code to let Fastow run his side partnerships, Lay signed off. He was a leader who wanted to be loved more than he wanted to be respected, and that need for approval made him incapable of saying no to the people around him. When the merger created Enron, Lay was 53 years old. He was already well connected in Washington. He had served on the boards of the Federal Reserve Bank of Dallas, the Interstate Natural Gas Association, and the Business Roundtable. He was friends with George H.W. Bush. He had donated generously to both political parties. He understood that in the energy business, your relationships with regulators mattered as much as your pipelines. Those connections ran deep. Lay was a major donor to George W. Bush's presidential campaign, and when Bush took office in 2001, Enron executives had a direct line to the White House. Lay's nickname in Washington was Kenny Boy, a term of endearment used by the Bush family. Enron's Political Action Committee was one of the largest corporate donors in America, spreading money across both parties with surgical precision. Between 1989 and 2001, Enron and its employees gave nearly $6 million to political campaigns. 258 members of Congress, more than half of both houses, received Enron contributions. This was not illegal. It was not even unusual by the standards of the time. But it created a culture in which Enron believed it was above the rules, because the people who wrote the rules were on its payroll. And in 1985, the regulatory environment was about to change in a way that would make Kenneth Lay a very rich man. Throughout the 1970s and early 1980s, natural gas prices had been tightly controlled by the federal government. The Natural Gas Act of 1938 had given the Federal Power Commission, later renamed the Federal Energy Regulatory Commission, authority over interstate gas sales. Prices were set by formula. Profits were limited. Innovation was stifled. But in the mid-1980s, a series of regulatory changes, beginning with FERC Order 380 in 1984 and culminating in Order 636 in 1992, fundamentally restructured the natural gas industry. Pipelines were required to separate their sales operations from their transportation operations. Third-party access was mandated. Prices were gradually deregulated. For a company like Enron, this was a gold rush. Suddenly, natural gas could be bought and sold like a commodity, traded on open markets, hedged with futures, speculated on by traders who had never seen a pipeline in their lives. Enron was perfectly positioned to become the middleman. The company had the pipelines. It had the relationships. It had the political connections to shape the rules as they were being written. And it had an appetite for risk that its more conservative competitors lacked. But there was something else happening too. Something that nobody fully appreciated at the time. The deregulation of natural gas was being driven in part by energy companies themselves, who argued that free markets would produce lower prices and greater efficiency. What nobody asked was, what happens when the middleman learns to manipulate the market? What happens when the trader discovers that volatility is more profitable than stability? Enron discovered both of those things, and the consequences would reshape the entire American economy. In 1990, Kenneth Lay hired a consultant from McKinsey & Company named Jeffrey Skilling. Skilling was 36 years old, Harvard MBA, intense, analytical, and utterly convinced that the future of energy was not in pipelines. It was in trading. Skilling had been working with Enron as a McKinsey consultant since 1987, and he had developed a radical idea. Instead of just moving gas through pipes, Enron should act like a bank for energy. It should buy gas from producers, sell it to consumers, and take a cut of every transaction. It should create financial products based on energy, futures, options, swaps, just like Wall Street did with stocks and bonds. It should become, in Skilling's words, a gas bank. Lay was initially skeptical. The pipeline business was safe and predictable. Trading was volatile and unproven. But Skilling was persuasive. He argued that deregulation would turn natural gas into a commodity, and that the company that dominated the trading of that commodity would become the most powerful energy company in the world. Lay gave him the green light. Skilling moved to Houston and began building the machine. Jeffrey Skilling was nothing like Kenneth Lay. Where Lay was diplomatic and consensus-seeking, Skilling was combative and absolutist. He believed in markets with an almost religious conviction. He believed that anything could be priced, traded, and optimized. He believed that smart people, and Skilling was very clear that he considered himself one of the smartest, could solve any problem with enough data and enough aggression. Former colleagues described him as someone who would argue a point until his opponents simply gave up from exhaustion. He once told a room full of energy executives that the pipeline business was dead, and that anyone who didn't understand that deserved to go bankrupt. This was the man Kenneth Lay put in charge of Enron's future. The machine Skilling built had several components. First, he created a division called Enron Gas Services, later renamed Enron Capital and Trade Resources, that would serve as the trading hub. Second, he recruited aggressively. He hired the smartest young MBAs from the best business schools, paying them salaries that far exceeded what pipeline executives earned. He created a culture of competition, rank and yank, they called it, where the bottom performers were fired every 6 months, and the top performers received bonuses that could reach 7 figures. Third, he imported an accounting technique from Wall Street called mark-to-market accounting. Mark-to-market sounds technical, but the concept is simple. Normally, when a company signs a long-term contract, say a 10-year agreement to supply natural gas to a utility, it books the profit gradually, year by year, as the gas is actually delivered. Mark-to-market says, no, you can book all the expected profit from that 10-year contract right now, in this quarter, as if the money were already in the bank. It assumes that the contract's future value can be calculated with precision. It assumes that markets are efficient and prices are predictable. In practice, it means you can report massive profits today for work you haven't done yet. And if those profits turn out to be imaginary, well, you'll deal with that problem later. Let me give you a concrete example of how this worked in practice. Suppose Enron signed a 20-year contract to supply natural gas to a power plant. Under traditional accounting, Enron would recognize revenue each year as it delivered the gas. Under mark-to-market, Enron would estimate the total profit from all 20 years, using its own internal models, and book that entire profit immediately in the quarter the contract was signed. If the estimates were wrong, Enron would simply adjust them in future quarters. But here is the critical detail. Those adjustments were buried in complex financial footnotes that almost no investor read. The headline numbers, revenue, earnings per share, showed the inflated figures. The corrections were hidden. It was a system that rewarded optimism and punished honesty. Because if you were conservative and booked a smaller profit, your division would look weaker, and in Skilling's rank-and-yank culture, looking weak meant getting fired. Enron asked the Securities and Exchange Commission for permission to use mark-to-market accounting for its natural gas futures contracts. The SEC granted that approval on January 30, 1992. It was one of the most consequential regulatory decisions of the decade. Because once Enron had permission to book imagined future profits as real current income, the company had every incentive to, and I choose this word carefully, to imagine as much profit as possible. Every long-term contract became an opportunity to inflate earnings. Every deal could be structured to show an immediate gain, even if the deal itself was structured to lose money in the long run. Jeffrey Skilling described mark-to-market this way. It's like having a speedboat instead of a rowboat. You can go faster, but you also have to watch for rocks more carefully. The problem is the people at the helm of that speedboat were not watching for rocks, they were looking for ways to go faster. By the mid-1990s, Enron Gas Services had become the most profitable division of the company. Skilling's traders were making money hand over fist. They were trading natural gas, electricity, crude oil, coal, and eventually more exotic commodities like weather derivatives. Financial contracts that paid out based on temperature. If a utility company was worried about a cold winter driving up heating demand, Enron would sell them a weather derivative that locked in their costs. If a farmer was worried about drought, Enron would sell them a rainfall contract. It was clever, it was innovative, and it was completely unregulated. The culture inside Enron's trading floor was legendary. It was aggressive, masculine, and fueled by a combination of adrenaline, arrogance, and alcohol. Traders worked 16-hour days. They shouted at each other. They threw things. They celebrated big wins with expensive dinners and trips to Las Vegas. The company encouraged this behavior. It created an environment where only the most aggressive, most confident, most ruthless traders survived. Jeffrey Skilling called it intellectual capital. Critics called it something else. The Enron trading floor was structured like a casino floor, and that was by design. Skilling had studied the cultures of Wall Street investment banks and hedge funds like D.E. Shaw and long-term capital management, and he wanted to replicate that intensity in Houston. The trading desks were arranged in an open-plan layout so that everyone could see and hear everyone else. Losing money was visible, and in a culture where the bottom 15% were fired every 6 months, visible weakness was fatal. One former trader described the environment this way. You walked in every morning knowing that if you weren't better than 85% of the people around you, you wouldn't be there in December. The result was a trading floor full of brilliant, terrified people making increasingly aggressive bets, because the only thing worse than losing money was not making enough of it. The rank and yank system meant that every 6 months, the bottom 15% of performers were fired and replaced with new hires. This created intense internal competition. It also created perverse incentives. If you knew you might be fired in 6 months unless you showed a profit, you had every reason to book that profit as quickly as possible, even if it meant bending the rules. Even if it meant booking a 10-year profit today on a contract that might go bad tomorrow. Even if it meant lying. In 1996, Enron's revenue was $13.3 billion. By 2000, it had grown to $101 billion. That is a 750% increase in 4 years. By the first 9 months of 2001, Enron was reporting revenue at an annualized rate of $185 billion, enough to place it 6th on the Fortune Global 500. The stock price hit $90.75 per share. The market capitalization exceeded $60 billion. Enron's stock was trading at 70 times earnings, meaning investors were paying $70 for every dollar of profit the company claimed to make. For context, a normal energy company trades at about 15 times earnings. The market was not just betting on Enron. The market was betting that Enron's growth would continue at that pace forever. To put the revenue growth in perspective, in the year 2000, Enron reported more revenue than Chevron and Texaco combined. More than Boeing, more than IBM, more than Procter & Gamble. This was a company that had been, 15 years earlier, a boring pipeline utility in Houston. And now it was, on paper, one of the largest corporations on earth. The Wall Street analysts who covered Enron, and there were many of them, because Enron was one of the most heavily covered stocks on the market, competed to produce the most bullish research reports. An analyst at Credit Suisse First Boston called Enron the Amazon.com of energy. An analyst at Goldman Sachs said Enron was creating markets that didn't exist before. Nobody wanted to be the analyst who downgraded Enron because Enron executives controlled access, and access meant investment banking fees worth millions of dollars. The analysts were not stupid. They were captured. Fortune magazine named Enron America's most innovative company for 6 consecutive years. Analysts competed to praise it. One analyst wrote, Enron is so far ahead of its competition it's not even in the same race. And in a sense, he was right, because Enron was not competing in the energy business anymore. It was competing in the business of making its stock price go up. And in that business, there was no competitor even close. By the late 1990s, Enron had a problem. The mark-to-market machine was generating enormous reported profits, but those profits were on paper. The company needed to keep investing in new projects and new acquisitions to sustain the illusion of growth, and those investments required cash. Real cash, not accounting fiction. Enron was borrowing heavily, and its balance sheet was starting to show it. The debt was piling up. If investors saw how much Enron was actually borrowing, they would realize the company's profits were a mirage. Enter Andrew Fastow. Fastow was Enron's chief financial officer. He was 40 years old in 2001, a graduate of Tufts University and Northwestern's Kellogg School of Management. He had joined Enron in 1990, the same year as Skilling, and had risen through the finance ranks. Fastow was not a flamboyant trader. He was a quiet, methodical financial engineer, and he had an idea that would change everything. The idea was this: create separate companies, legally independent entities, that would borrow money on Enron's behalf. Since these entities were technically not part of Enron, their debt would not appear on Enron's balance sheet. Enron could then use the money from these entities to buy assets, make investments, and pay expenses, all while reporting a clean balance sheet to investors. These entities were called Special Purpose Entities, or SPEs. Andrew Fastow is the most complicated figure in the Enron story. Unlike Skilling, who was ideologically committed to markets, or Lay, who was committed to his own reputation, Fastow was motivated by something simpler. He wanted to be rich. He was 40 years old, living in a Houston mansion worth millions, and he was the CFO of what was supposedly the most innovative company in America. But that wasn't enough. He wanted to build his own fortune, not through Enron stock, but through the very entities he was creating to hide Enron's debt. Fastow understood something that Skilling and Lay either missed or chose to ignore. The SPE structure did not just hide debt. It could also generate enormous personal wealth for the person who controlled it, and Fastow positioned himself to be that person. The first major SPE was called JEDI, a playful name, like the movies. JEDI stood for Joint Energy Development Investments, and it was created in 1993 as a partnership between Enron and the California Public Employees Retirement System, known as CalPERS. JEDI was legitimately structured. CalPERS put in real money, Enron put in real assets. It worked. But in 1997, CalPERS wanted to cash out. This created a problem. If Enron simply bought CalPERS' stake, JEDI's debt would reappear on Enron's balance sheet. So Fastow created a second entity, Chuco, named after the Star Wars character Chewbacca, to acquire CalPERS' stake in JEDI. Chuco was funded almost entirely with debt guaranteed by Enron. It had essentially no independent capital. It was a shell, but because it was technically a separate legal entity, Enron was able to keep the entire structure off its balance sheet. The accounting impact was staggering. By hiding JEDI's debt through Chuco, Enron concealed $628 million in liabilities and inflated its earnings by $405 million. This was not a rounding error. This was 40% of Enron's reported earnings improvement in 1997. Without Chuco, Enron would have reported lower earnings in 1997 than in 1996, a decline that would have alarmed investors and sent the stock price down. Let me explain why Chuco was fraudulent, because this gets to the heart of the entire Enron scheme. Under accounting rules, an SPE could be kept off a company's balance sheet only if it met two conditions. First, at least 3% of the SPE's capital had to come from an independent outside investor, someone who had no affiliation with the company. Second, that outside investor had to have genuine control over the SPE, meaning they were putting their own money at risk. Chuco failed both tests. The supposed outside investor was Michael Copper, an Enron employee who worked directly for Fastow. The money Copper invested came from a line of credit guaranteed by Enron itself, and the investment was structured so that Copper bore essentially no risk. Enron guaranteed his return. Chuco was a puppet show. The strings were held by Enron. But because the paperwork said the strings were held by someone else, Andersen signed off, and the debt stayed hidden. The Chuco structure worked so well that Fastow decided to replicate it. In 1999, he created LJM, named after his wife and children, and LJM2. These were private equity funds that Fastow personally managed. And here is where the conflict of interest becomes glaring. As CFO of Enron, Andrew Fastow's fiduciary duty was to get the best possible deal for Enron shareholders. As manager of LJM, Fastow's fiduciary duty was to get the best possible deal for LJM investors. Those two duties were in direct opposition. Every transaction between Enron and LJM was a negotiation where Fastow was on both sides of the table. The LJM entities raised approximately $390 million from banks including JP Morgan Chase, Citigroup, and Credit Suisse. With that capital, They purchased assets from Enron, mostly troubled or underperforming assets that Enron needed to get off its books. If the assets turned out to be worthless, LJM took the loss, not Enron. If they turned out to be valuable, LJM kept the profit. Fasto personally made approximately $30 million from his management of these partnerships. Think about what $30 million in personal profit meant in practice. Fasto was negotiating with himself. He would walk into a meeting wearing his Enron CFO hat and say, "This asset is worth $100 million. Then he would walk into the same meeting wearing his LJM hat and say, "I'll buy it for $80 million. Then, in his LJM hat, he would sell it a year later for $120 million. The $20 million profit, entirely derived from Enron's assets, went into Fasto's pocket. And the entire transaction was approved by Enron's board of directors, who had voted to waive their own code of ethics to allow it. The most complex SPEs were the Raptors, 4 entities named after the swift, deadly dinosaurs in Jurassic Park. The Raptors were created in 2000 and 2001 to hold approximately $1.2 billion in Enron assets and $2.1 billion in derivative contracts. Their purpose was to hedge against declines in the value of Enron's investments, but the Raptors were not real hedges. They were circular. The Raptors' only capital was Enron stock. If Enron's stock price fell, the Raptors had no capital to cover their obligations. The hedge only worked if Enron stock kept going up, which meant it was not a hedge at all. It was a bet that the stock would never fall. To understand why this matters, consider what a real hedge looks like. If you own a house worth $500,000, you buy fire insurance from an insurance company that has capital from thousands of premium-paying customers. If your house burns down, the insurance company pays you because it has real money from other people. The Raptors were structured as if Enron was selling fire insurance to itself, using its own house as the collateral. If the house burned down, there was no money to pay. The collateral was gone too. It was insurance that only worked if nothing bad ever happened. The banks that structured these SPEs, JP Morgan Chase, Citigroup, Credit Suisse, Merrill Lynch, were not innocent bystanders. They earned millions in fees for designing and executing these transactions. Some of them were later sued by Enron shareholders and paid hundreds of millions in settlements. They structured the deals. They knew the accounting treatment. And they chose not to ask questions because the fees were too lucrative. By 2001, the Raptors were hemorrhaging. Enron had to inject more and more stock into them to keep them solvent. The SPE structure was collapsing under its own weight. And Fasto knew it. He later testified that he knew the Raptors were unsustainable by early 2001, almost a full year before the bankruptcy. He kept them running because shutting them down would have required Enron to acknowledge massive losses, which would have triggered a stock decline, which would have destroyed the Raptors even faster. It was a death spiral, and everyone at the top of Enron knew where it was heading. Despite the complexity of the fraud, Enron's stock continued to climb. In December 2000, it hit $83 per share. The company had a market capitalization exceeding $60 billion. It was trading at 70 times earnings, a valuation that assumed Enron would grow at extraordinary rates for the foreseeable future. How did the fraud go undetected for so long? The answer has 4 parts. First, the accounting was technically legal, or at least it existed in a gray area that the SEC had not yet addressed. The mark-to-market method had been approved. SPEs were common in structured finance. What made Enron's use of them fraudulent was the lack of economic substance, but that took investigators months to unravel. Second, the rating agencies Moody's and Standard & Poor's gave Enron investment-grade ratings until 4 days before its bankruptcy. They relied on Enron's public financial statements, which showed a healthy company with manageable debt. The SPEs were designed specifically to hide the debt, and as long as Enron's auditors signed off, the rating agencies had no reason to dig deeper. But let me pause on the rating agencies for a moment, because their failure was not passive. It was structural. Moody's and S&P are paid by the companies they rate. If a rating agency gives a company a bad rating, that company can take its business to a competitor. The agencies have a financial incentive to be generous. And in the late 1990s, as Enron grew more complex, the rating agencies' analysts were overwhelmed. Enron's financial statements ran to hundreds of pages, with footnotes that referenced other footnotes that referenced still more footnotes. Decoding the SPE structure required forensic accounting skills that most rating agency analysts simply did not have. So they did what most people do when faced with information they cannot understand. They trusted the experts who said everything was fine. Those experts were Arthur Andersen. Third, and this is crucial, Enron's auditor was Arthur Andersen. Andersen was one of the Big Five accounting firms, with a reputation for excellence stretching back nearly a century. It was Andersen's job to verify Enron's financial statements. But Andersen also made millions of dollars in consulting fees from Enron, fees that far exceeded what it earned from the audit itself. When you audit a company's books and simultaneously work as a paid consultant to that same company, you have an inherent conflict of interest. If you raise too many red flags, you lose the consulting contract. Andersen chose not to raise them. The relationship between Enron and Arthur Andersen was uniquely compromised, even by the standards of the time. Andersen did not just audit Enron's books. Andersen effectively ran Enron's internal accounting department. Enron outsourced its entire internal audit function to Andersen. Andersen employees worked inside Enron's Houston headquarters, side by side with Enron employees, using Enron email addresses and attending Enron meetings. One Andersen partner, David Duncan, was so embedded in Enron that he effectively functioned as an Enron employee. Duncan approved the SPE structures, signed off on the mark-to-market valuations, and personally earned bonuses tied to the volume of Enron-related business he generated. When Andersen's own internal risk management team raised concerns about Enron's accounting practices, Duncan and his Houston team overruled them. The Chicago headquarters of Andersen chose not to intervene because the Enron account generated approximately $52 million in annual fees. That was roughly $1 million per week. No partner at Andersen was going to jeopardize a $1 million a week client by asking uncomfortable questions. Fourth, Enron's board of directors was stacked with luminaries who had no expertise in energy finance. Former Secretary of State Henry Kissinger, former Senator John Danforth, a former accounting professor from Stanford. They were distinguished people with distinguished reputations, but they did not understand the complex financial structures Fastow had created, and they did not ask the right questions. In October 1999, Enron's board voted to waive the company's code of ethics to allow Andrew Fastow to manage the LJM partnerships. This was an explicit acknowledgement that Fastow had a conflict of interest. The board knew it, Fastow knew it, and they decided to allow it anyway. That waiver would become one of the most damning pieces of evidence in the subsequent investigations. None of the distinguished board members, not Kissinger, not the former senator, not the Stanford professor, raised a sustained objection. The board met for approximately 5 hours per year to discuss Enron's financial affairs. The presentations they received were prepared by Enron's own finance team, the same team that was hiding the debt. The board members were paid approximately $350,000 per year in cash and stock for their service. They asked polite questions. They received polite answers. And they went home. The board was not corrupt in the sense of taking bribes. It was worse. It was ornamental. It existed to provide the appearance of oversight without the substance. In early 2001, the California electricity crisis was the first sign that Enron's house of cards was starting to shake. The crisis had been brewing for years. California had partially deregulated its electricity market in 1996, creating a system where utilities bought power on the open market while retail prices remained capped. When demand surged and supply tightened in 2000 and 2001, wholesale electricity prices exploded, and Enron was there to exploit every inch of the system. To understand what Enron did in California, you have to understand the market structure. California's deregulation created a system called the California Power Exchange, where utilities like Pacific Gas and Electric were required to buy electricity on the spot market rather than through long-term contracts. The theory was that competition would drive prices down. In practice, it created a market that was extraordinarily vulnerable to manipulation. A single trader at a single desk in Houston could submit bids or schedules that would create artificial scarcity or artificial congestion on the transmission grid. The result would be a spike in wholesale electricity prices that Enron's other traders, sitting at desks a few feet away, could exploit. When investigators later obtained recordings of Enron traders, tapes the company was required to keep by law, they heard a level of cynicism that shocked the public. One trader, when asked about a scheme to create artificial congestion on a transmission line, replied, "It's like taking candy from a baby." Another trader described a plan, codenamed Death Star, which involved exporting power out of California and re-importing it at a higher price. creating the illusion of congestion. Traders laughed about grandma getting screwed by high electricity bills. The tapes were played before Congress. They made national news. And they permanently destroyed any remaining goodwill toward the company. The Federal Energy Regulatory Commission eventually found that Enron traders had manipulated California's energy markets through at least 4 distinct schemes, creating false congestion, exporting power and re-importing it at higher prices, scheduling power deliveries that were never intended to be delivered, and shutting down generating plants during peak demand for maintenance. Enron's trading desk called these schemes by names that sounded like video game levels: Death Star, Fat Boy, Load Shift, Get Shorty. The schemes cost California ratepayers an estimated $1 billion. The human cost of these schemes was immense. During the winter of 2000-2001, California experienced rolling blackouts, the first in the state's modern history. Hospitals ran on backup generators. Traffic lights went dark. Businesses closed. Senior citizens in unair-conditioned apartments suffered heat stroke during the summer months. And while this was happening, Enron traders were on tape laughing about the money they were making. The disconnect between the trading floor and the real world had become absolute. The traders saw only numbers on screens: prices, volumes, spreads. They did not see the families who could not pay their electricity bills, the small businesses that went under, the communities plunged into darkness. In August 2001, a vice president of corporate development named Sharon Watkins sat down at her computer and wrote a letter. She was 41 years old, a CPA who had worked at Arthur Andersen before joining Enron. She knew the accounting rules inside and out. And she had realized that the company was not just bending the rules, it was breaking them. Watkins sent an anonymous letter to Kenneth Lay on August 15, 2001. The letter began, "I am incredibly nervous that we will implode in a wave of accounting scandals." Over several pages, she laid out the structure of the Raptor SPEs, explained why they were fraudulent, and warned that Enron could become a wave of accounting scandals. She wrote, "We have a potential conflict of interest problem with the CFO running LJM, and we have an extremely serious accounting problem with the Raptor structures." Sharon Watkins is often described as a hero, and in many ways she was. But her story is more complicated than that. Watkins did not go to the SEC. She did not go to the press. She wrote a letter to the CEO. She gave the company a chance to fix the problem quietly. She later told investigators that she was scared. Scared of losing her job. Scared of being blackballed in Houston's corporate community. Scared of being wrong. She was not trying to blow up Enron. She was trying to save it. The fact that the most courageous act in the entire Enron story was a private letter to the CEO tells you everything you need to know about the culture of silence that had enveloped the company. Lay received the letter. He met with Watkins. He assured her he would investigate. He hired the law firm Vinson and Elkins to look into her allegations. But the scope of the investigation was deliberately limited. Vinson and Elkins was told not to investigate the underlying accounting issues, only to review whether the allegations had merit. They concluded that no further action was needed. In August 2001, Jeffrey Skilling abruptly resigned as CEO. He had been in the position for only 6 months, having replaced Ken Lay in February. Skilling cited personal reasons. The stock price, which had been declining all year, dropped further. Kenneth Lay returned as CEO, but the damage was done. The timing of Skilling's resignation has been debated for 20 years. Skilling insisted he left for genuine personal reasons. His marriage was troubled, he was exhausted, and he had always planned to leave early. Prosecutors argued he saw the collapse coming and wanted to distance himself before it happened. The truth is probably somewhere in between. Skilling was a brilliant man who could rationalize almost anything. He may have convinced himself that the company was fundamentally sound, even as the SPEs collapsed around him. Or he may have known exactly what was coming and chosen to save himself. We will never know for certain. But what we do know is this. When the CEO of a company that has reported nothing but growth for years suddenly resigns after 6 months, citing personal reasons, that is almost always a signal that something is deeply wrong. And the market, which is supposed to be efficient, which is supposed to price in all available information, took weeks to figure that out. Behind the scenes, the SPEs were collapsing. Enron had to take massive write-downs. The Raptors alone required a $1.2 billion charge. On October 16, 2001, Enron announced a third-quarter loss of $618 million and a $1.2 billion reduction in shareholder equity. The SEC opened an informal inquiry the same day. On November 8, 2001, Enron announced that it was restating its financial results for the previous 4 years. The restatement reduced reported earnings by $591 million, virtually eliminating all of Enron's reported profit for fiscal year 1997. The company acknowledged that the SBEs should have been consolidated onto its balance sheet. The billions in debt that had been hidden now had to be declared. The next 3 weeks were a death spiral. Enron's credit rating was downgraded to junk status by Moody's and Standard & Poor's. The company's trading partners demanded cash collateral billions of dollars that Enron did not have. Dynegy, a rival energy company, had agreed to merge with Enron in a deal that would have provided a lifeline. But on November 28, 2001, after the credit downgrade, Dynegy pulled out. That same day, Enron's stock closed at 61 cents per share, down from $90 1 year earlier. The Dynegy deal deserves special attention because it illustrates how thoroughly Enron had deceived even its closest peers. Dynegy had agreed to buy Enron for roughly $9 billion in stock, a fraction of Enron's peak $60 billion valuation, but still enough to save the company from bankruptcy. Dynegy's CEO, Chuck Watson, was a Houston native who wanted to be the hero who rescued his hometown company. But as Dynegy's due diligence team dug into Enron's books, they discovered that the hole was far deeper than anyone had disclosed. On November 19, 2001, Enron filed its third quarter report with the SEC. The report revealed that Enron had essentially burned through billions of dollars in cash over the preceding months, and that the SPEs were in far worse shape than anyone had admitted. Watson called Lay and demanded an explanation. The explanation never came. On November 28, Dynegy walked away. The merger that was supposed to save Enron had died because Enron could not tell the truth, even to the company that was trying to rescue it. On December 2, 2001, Enron filed for Chapter 11 bankruptcy protection. It listed $63.4 billion in assets, making it the largest corporate bankruptcy in American history at that time. It would be surpassed the following year by WorldCom. But Enron's bankruptcy was different. WorldCom's fraud was simpler, inflating earnings by booking expenses as capital investments. Enron's fraud was systemic. It involved hundreds of entities, thousands of transactions, and a decade of deliberate deception. When Enron collapsed, approximately 4,000 employees lost their jobs immediately. But the human cost went far deeper than the headlines captured. Let me tell you about one specific person. Charles Prestwood was an electrician who had worked at Enron for 33 years. He started at Houston Natural Gas before the merger, when the company was a straightforward pipeline business. Over 3 decades, he had watched the company transform from a utility into a trading casino. He did not understand the financial instruments his company was trading. He did not know what a special purpose entity was. But he did know one thing. He had put his retirement savings into Enron stock because the company encouraged it, matching his contributions with shares and telling him it was a safe investment. When Enron collapsed, Charles Prestwood's 401k, worth $450,000 10 months earlier, was worth nothing. He was 61 years old. He could not afford to retire. He could not afford to stop working. He came to work one day and found the doors locked and a security guard telling him to go home. Charles Prestwood's story was not unique. It was repeated thousands of times across Houston. Enron's 401k retirement plan was heavily invested in company stock. The company had encouraged employees to buy Enron shares. Kenneth Lay himself had repeatedly told employees that the stock was a bargain. Nearly 62% of the 15,000 employees' retirement savings were in Enron stock, much of it purchased at around $83 per share. When the stock became worthless, those savings vanished. There is a detail in this story that is often overlooked, and it is damning. In October 2001, as the company was spiraling toward collapse, Enron imposed a blackout period on its 401k plan, a period during which employees were prohibited from selling their Enron stock. The ostensible reason was that Enron was switching 401k administrators, a routine corporate change. But the blackout lasted from October 17th to November 12th, 2001, precisely the window during which the stock fell from roughly $30 to under $10. Employees watched their retirement savings evaporate in real time, powerless to do anything about it. Meanwhile, Enron executives, including Kenneth Lay, sold approximately $1 billion in Enron stock during the years leading up to the collapse. Lay personally sold over $100 million worth. The employees were locked in. The executives were cashing out. That is not a coincidence. That is a system designed to benefit the people at the top at the expense of everyone else. In total, 20,000 employees and former employees eventually won an $85 million pension settlement in May 2004. That worked out to approximately $3,100 per person. $3,100 to replace $450,000 in retirement savings. The formula was calculated based on how long you had worked at Enron and how much company stock you held. The maximum payout was about $7,000. The minimum was a few hundred. The Enron collapse also destroyed Arthur Andersen, one of the 5 largest accounting firms in the world. In June 2002, Andersen was found guilty of obstruction of justice for shredding Enron-related audit documents while the SEC investigation was underway. The firm surrendered its license to practice as a certified public accountant in August 2002. 85,000 employees worldwide lost their jobs. The shredding itself is one of the most haunting details of the Enron story. In October 2001, as the SEC inquiry was beginning, David Duncan, the Andersen partner in charge of the Enron audit, ordered his team to begin destroying documents. Not just routine cleanup, not just archiving. Systematic destruction. Shredders ran around the clock in Andersen's Houston office. Boxes of Enron-related papers were loaded into trucks and hauled away. Emails were deleted. When the SEC requested documents, Andersen's lawyers argued that the firm had followed its own document retention policy, a policy that said documents not needed for the audit should be destroyed. But the timing and scale of the destruction made it clear that this was not routine policy. It was a cover-up. The shredding, more than any other single act, convinced the public that Andersen knew it had done something wrong. The conviction was later overturned by the U.S. Supreme Court in 2005. Chief Justice William Rehnquist, writing for a unanimous court, ruled that the jury instructions had been improperly broad. But by then, the damage was done. Andersen had already ceased operations. The firm that had audited some of the largest companies in the world, that had been a pillar of American finance for nearly a century, was gone. The criminal investigations that followed Enron's collapse were the most extensive white-collar prosecutions in American history. 16 individuals pleaded guilty to crimes related to the fraud. 5 others, including 4 Merrill Lynch executives, were convicted at trial. But the government wanted the 3 men at the top: Kenneth Lay, Jeffrey Skilling, and Andrew Fastow. The prosecution of Enron was led by the Department of Justice's Enron Task Force, a specially assembled team of prosecutors, FBI agents, and forensic accountants. The task force spent more than 3 years building its case. They interviewed hundreds of witnesses. They reviewed millions of pages of documents. They traced every transaction, every SPE, every email, and they built their strategy around one central insight. The only way to convict the top executives was to flip someone who had been at the center of the fraud. That someone was Andrew Fastow. Andrew Fastow was the first to crack. Initially charged with 98 counts including fraud, money laundering, insider trading, and conspiracy, Fastow struck a deal. He pleaded guilty to 2 counts of conspiracy and agreed to testify against his former colleagues. He was sentenced to 10 years in prison and served approximately 6. His wife, Leah Fastow, who had also worked at Enron and helped structure some of the SPEs, pleaded guilty to filing a false tax return and served 1 year. Fastow's cooperation was essential to the prosecution's case. He was the architect of the SPE structure. He could explain, in excruciating detail, how each entity worked, who approved it, and what they knew. His testimony helped convict the men above him. Fastow's deal was controversial. Many observers, including Enron employees who had lost everything, felt that 10 years was too lenient for a man who had personally pocketed $30 million while helping destroy a $60 billion company. The Department of Justice defended the deal on the grounds that without Fastow's testimony, Skilling and Lay would likely have walked free. It was a classic prosecutor's dilemma. Let the smaller fish go partly free to catch the bigger fish. Whether the trade-off was worth it depends on your perspective. What is not debatable is this. On the witness stand, Andrew Fastow calmly and methodically described a fraud of staggering scope. He explained how he had presented the SPE structures to the board, how Skilling had approved them, how Lay had been briefed. He was the prosecution's most devastating witness because he was the only person who understood the entire machine. Jeffrey Skilling's trial began in January 2006. The prosecution argued that Skilling had been the architect of Enron's fraudulent culture, that he had created the pressure to report ever-increasing profits, and that he knew the SPEs were being used to hide losses. Skilling's defense was that he was a businessman, not an accountant, that he had relied on Andersen and Enron's legal team to ensure the practices were legal, and that he had left the company in August 2001, before the collapse, because he genuinely believed the company was healthy. On the witness stand, Skilling was combative. He did not retreat. He did not apologize. He argued that Enron's business model was sound, that the SPEs were vetted by lawyers and accountants, and that the collapse was caused by a crisis of confidence, a bank run, essentially, rather than by fraud. It was a bold defense, and for a while it seemed to be working. Several jurors later said they found Skilling credible in his first days on the stand. But then the prosecution introduced the tapes, recordings of Enron executives discussing the SPEs, discussing the earnings manipulation, discussing the need to keep the stock price up at all costs. And they introduced Fastow, who sat in the witness box and explained, deal by deal, how the fraud had been structured and who had approved it. The jury deliberated for 5 days. On May 25, 2006, they convicted Skilling on 19 of 28 counts of securities fraud and wire fraud. He was sentenced to 24 years and 4 months in federal prison. In 2013, the Department of Justice reduced his sentence by 10 years as part of a negotiated agreement. Skilling was released from federal custody in 2019. Kenneth Lay's trial ran concurrently with Skilling's. Lay's defense was simpler. He claimed he had been deceived by Skilling and Fastow. He said he had no idea that the company's financial statements were fraudulent. The prosecution argued that Lay was either complicit or willfully blind, and that as CEO, willful blindness was just as culpable as knowledge. Lay's testimony was the opposite of Skilling's. Where Skilling fought, Lay charmed. He spoke softly. He talked about his humble upbringing in Missouri. He talked about his faith. He talked about the thousands of employees who depended on him. He presented himself as a victim, a good man betrayed by subordinates he had trusted. It was a performance designed to appeal to the jury's sympathy, and it might have worked, if not for one problem: the evidence. The prosecution presented documents showing that Lay had been personally briefed on the SPE structures. They presented emails showing that Lay had been warned about the accounting issues by multiple people, including Sharon Watkins. They presented records showing that Lay had sold over $100 million in Enron stock during the years the fraud was ongoing, and that he had used a line of credit from Enron itself to do it, repaying the loans with Enron stock that was, in essence, worthless monopoly money. On May 25, 2006, the same day Skilling was convicted, Lay was found guilty on all 6 counts of securities and wire fraud. Each count carried a potential sentence of 5 to 10 years. The SEC was seeking more than $90 million in fines and penalties. Kenneth Lay never served a day in prison. On July 5, 2006, less than 6 weeks after his conviction, he died of a heart attack at his vacation home in Colorado. He was 64 years old. His convictions were automatically vacated under U.S. law, which abates criminal charges upon the death of the defendant. The SEC continued to pursue his estate for fines, but the criminal case was over. Lay's death added an almost Shakespearean dimension to the Enron tragedy. The man who had built the company, who had presided over its rise and fall, who had been convicted of crimes that would have sent him to prison for the rest of his life, escaped justice not through legal maneuvering, but through a heart attack. His family and supporters insisted he had been unfairly prosecuted. His critics said he had gotten away with it. The truth, as always, was more complicated. Kenneth Lay was not a simple villain. He was a man who genuinely believed in his own goodness, who could not accept that the system he had built was fraudulent, and who went to his grave insisting he had done nothing wrong. He was, in the end, a victim of his own self-deception, a man who had lied so long to others that he had come to believe his own lies. The Enron scandal, combined with the even larger WorldCom fraud that emerged in 2002, triggered the most significant corporate governance legislation since the Great Depression. Congress passed the Sarbanes-Oxley Act, officially the Public Company Accounting Reform and Investor Protection Act of 2002, and President George W. Bush signed it into law on July 30, 2002. Sarbanes-Oxley, or SOX, was described by its architects as a mirror image of Enron. Its provisions were written specifically to address each category of abuse that Enron had exploited. The speed with which SOX was passed is itself remarkable. The bill was introduced in the House by Representative Michael Oxley and in the Senate by Senator Paul Sarbanes in February 2002. It passed the House by a vote of 334 to 90 and the Senate by a vote of 99 to 0. It took less than 6 months from introduction to signing. By the standards of American politics, where major legislation typically takes years, if it passes at all, this was lightning speed. It reflected a genuine bipartisan consensus that something had gone terribly wrong and needed to be fixed. But speed has a cost. When legislation is written quickly in response to a crisis, it tends to address the last crisis rather than the next one. First, SOX required CEOs and CFOs to personally certify the accuracy of their company's financial statements. Before Enron, executives could claim ignorance of accounting details. After SOX, ignorance was not a defense. If the financial statements were wrong, the CEO and CFO were personally liable. Criminal penalties for securities fraud were increased to up to 25 years in prison. Second, SOX created the Public Company Accounting Oversight Board, the PCAOB, to regulate the accounting industry. Before Enron, accountants were essentially self-regulated. After SOX, the PCAOB had the authority to set auditing standards, inspect accounting firms, and discipline accountants who failed in their duties. Third, SOX prohibited accounting firms from providing most consulting services to the companies they audited. Enron's auditor, Arthur Andersen, had made more money from consulting than from auditing. After SOX, that conflict of interest was eliminated. Fourth, SOX strengthened whistleblower protections. The law created criminal penalties for retaliating against whistleblowers and established a private right of action for employees who were fired or discriminated against for reporting fraud. Sharon Watkins would later testify before Congress about her experience, and the provisions protecting future whistleblowers were directly inspired by her case. The most controversial provision of SOX was Section 404, which required companies to document and test their internal controls over financial reporting. This provision was intended to prevent the kind of off-balance sheet deception that Enron had perfected. In practice, it became enormously expensive. A 2009 SEC study found that the average public company spent approximately $2.3 million per year complying with Section 404. For small companies, those with market capitalizations under $75 million, the costs were proportionally much higher, sometimes exceeding 1% of revenue. Critics argued that Section 404 was a massive regulatory burden that did little to prevent fraud. Supporters argued that the costs were trivial compared to the $74 billion Enron shareholders had lost. Both sides had a point. Sarbanes-Oxley was supposed to be the end of corporate fraud, but it wasn't. In the years since SOX, we have seen the subprime mortgage meltdown of 2008, which wiped out trillions in value. We have seen Bernie Madoff's $65 billion Ponzi scheme. We have seen Wells Fargo's fake account scandal. We have seen Wirecard's $2 billion fraud in Germany. We have seen Nikola's fraud about a truck that couldn't drive. We have seen FTX's $40 billion collapse, run by a founder who, like Ken Lay, cultivated an image of visionary genius while building a house of cards. Why does fraud keep happening despite all these regulations? There are a few reasons. First, Sarbanes-Oxley increased the cost of compliance dramatically. By some estimates, the average public company now spends over $2 million per year on SOX compliance. This has had an unintended consequence. It pushed many smaller companies out of the public markets, making it harder for young companies to go public and easier for fraud to hide in private markets where SOX does not apply. Second, the accounting firms that survived the Andersen collapse, the Big Four, became more concentrated and more powerful. Today, Deloitte, PwC, EY, and KPMG audit virtually every public company in America. They still earn consulting fees from the companies they audit. The same conflict of interest that doomed Andersen is still present, just more carefully managed. Third, corporate fraud has shifted to new forms that the old regulations did not anticipate. Cryptocurrency, SPACs, social media hype stocks. These are the new Enrons, and they operate in regulatory gaps that did not exist when Sarbanes-Oxley was written in 2002. But there is a fourth reason, and it is the most uncomfortable one. Sarbanes-Oxley was designed to fix the plumbing, to make financial reporting more accurate, to make auditors more independent, to make executives more accountable. It did those things reasonably well. What it did not fix, and what no law can fix, is the incentive structure. The fundamental problem that created Enron was not a loophole in accounting rules. It was a system in which executives were paid primarily in stock and stock options, creating an overwhelming incentive to inflate the stock price by any means necessary. Skilling and Lay did not commit fraud because the rules allowed it. They committed fraud because the incentives demanded it. As long as executive compensation is tied to stock price, and as long as stock price can be manipulated through accounting, the Enron pattern will repeat itself, not because the lessons were forgotten, but because the incentives have not changed. So what did we actually learn from Enron? Here is the uncomfortable truth. We learned a great deal about accounting standards, audit procedures, and corporate governance. The Sarbanes-Oxley Act made financial reporting more rigorous. The PCAOB improved audit quality. CEOs now sign their financial statements under penalty of perjury. Whistleblowers have stronger protections. These are meaningful improvements. But we did not learn how to prevent fraud. We learned how to make fraud harder to conceal, but we did not eliminate the incentive to commit it. As long as executive compensation is tied to stock price, as long as quarterly earnings matter more than long-term sustainability, and as long as the people who approve financial statements are the same people who benefit from inflated numbers, fraud will continue. Let me give you a statistic that should trouble you. Between 1992 and 2001, the average CEO pay at S&P 500 companies increased from roughly $2.7 million to over $15 million. Stock options accounted for nearly half of that increase. The shift from cash compensation to stock-based compensation was sold as a way to align executive interests with shareholder interests. In theory, if the CEO owned stock, the CEO would work harder to make the stock valuable. In practice, it created an incentive to make the stock appear valuable, which is not the same thing. Enron's executives did not need to build a sustainable business. They needed to produce quarterly earnings that would drive the stock price up long enough for them to sell. And that is exactly what they did. Between 1999 and 2001, Enron's top executives sold over $1 billion in stock. The people who bought that stock, the pension funds, the retail investors, the employees who were locked into their 401k plans, were left holding worthless paper. The alignment of incentives was an illusion. The real alignment was between executives and their own bank accounts. The number of SEC enforcement actions for financial reporting fraud has actually increased since Sarbanes-Oxley, not decreased. In the decade after SOX, the SEC brought an average of 60 fraud cases per year, more than in any decade before. The reforms made it easier to catch fraud after it happened, but they did not make it less likely to occur. The Enron story has one more lesson that is rarely discussed. The 20,000 employees who lost their retirement savings did not lose them because the market declined. They lost them because they were forced by company policy to hold Enron stock in their 401k accounts. At its peak, Enron stock represented 62% of the retirement plan's assets. Most employees could not sell their shares during the collapse because a blackout period was imposed while the company switched 401k administrators. That was not a coincidence. The timing of that blackout period would later be investigated by Congress. The 401k blackout was not an isolated incident. It was a feature of the system. When a company matches your retirement contributions with company stock instead of cash, and when that stock cannot be diversified or sold during blackout periods, you are not an investor. You are a hostage. Your retirement depends entirely on the honesty of the executives who run your company, and if those executives are dishonest, your retirement is gone. The Enron employees did not fail to diversify. They were prevented from diversifying. They did not make bad investment decisions. The decision was made for them. The lesson of the Enron 401k is not that employees should have been smarter. The lesson is that a retirement system that ties workers' futures to a single company's stock is a retirement system designed to fail. And yet, 20 years later, millions of American workers still hold concentrated positions in their employer's stock. The law did not change. The incentives did not change. Only the names changed. Jeffrey Skilling was released from federal custody in 2019. Andrew Fastow was released earlier. Ken Lay died before serving a day. Arthur Andersen does not exist anymore. Enron's name is a punchline, a shorthand for corporate fraud. But the $74 billion that Enron shareholders lost was real. The 4,000 employees who lost their jobs on a single day in December 2001 were real. The 20,000 employees who lost their retirement savings were real. The 85,000 Arthur Andersen employees who lost their jobs were real. And the question, the same question that Sharon Watkins asked in her anonymous letter in August 2001, remains unanswered. When will we stop letting this happen? When someone writes the history of the early 21st century, the Enron scandal will not appear as an anomaly. It will appear as a template. The pattern is now well established. Deregulation creates new markets. New markets create opportunities for speculation. Speculation creates fortunes. Fortunes create pressure to sustain growth. Pressure to sustain growth creates fraud. Fraud collapses. Congress passes a law. The law addresses the last fraud. And the cycle begins again. We have seen it with Enron. We have seen it with the 2008 financial crisis. We have seen it with FTX. We will see it again. The names and the instruments will change, from energy derivatives to mortgage-backed securities to crypto tokens, but the underlying dynamic is the same. We build machines we do not fully understand. We celebrate the people who profit from them, and we act surprised when they break. The Enron Tower still stands at 1400 Smith Street in Houston. The giant E logo that once glowed from its top was removed years ago. The building was renamed in 2004, then again in 2018. Today it houses law firms, energy companies, and technology startups. You would never know that the most famous corporate fraud in American history unfolded inside its walls. But the lessons of Enron are not in that building. They are in the laws that were written in response to its collapse. They are in the SEC filings that are now signed under penalty of perjury. They are in the thousands of pages of Sarbanes-Oxley compliance documentation that every public company in America must file. And they are in the fact that, 20 years later, we are still talking about Enron not as a historical curiosity, but as a template, because new Enrons are created every year. The names change: Enron, WorldCom, Madoff, FTX. But the pattern remains the same: a charismatic leader, a complex financial structure that only insiders understand, a culture that rewards those who don't ask questions, and a regulator that arrives too late. The question is not whether the next Enron will happen. The question is whether we will recognize it in time. I want to leave you with one final thought. The Enron scandal produced thousands of pages of legislation, hundreds of court filings, and dozens of books. But the entire tragedy can be reduced to a single sentence. People will exploit any system if the rewards for exploitation are large enough and the consequences are small enough. That is not a problem of accounting. It is not a problem of regulation. It is a problem of human nature. And no law, no matter how carefully drafted, can legislate human nature out of existence. What laws can do is raise the cost of exploitation and lower the rewards. Sarbanes-Oxley did both of those things, and it made a difference. But the gap between what the law can accomplish and what human greed can circumvent will always exist. The question, the only question that matters, is whether we are willing to keep closing that gap, knowing it can never be closed completely. Because if we stop trying, the next Enron will not just happen. It is already happening, we just haven't found it yet.